Hey, it's Joel Olson coming at you another variable rate update. First week of August in 2022. Um, some of my video equipment broke. I was hoping to get some of the videos just a little bit higher quality and everything. But anyway, didn't want to delay the update any longer. Next Bank of Canada meeting is not until the first week of September, so still a bit of time. A few things to be aware of that have happened this week. So first of all, a enormous drop in fixed rates. Is that expected? Why, yes, it is. Because we know that bond yields follow fixed rates and set the price of fixed rates. Bond yields, as their spread changes, um, fixed rates follow a number of days later. So, big change on the fixed rate situation. I suppose that's an obscure thing in the sense that, like, prime rate being where it is, we're getting close to the fixed rate at the moment being even with what the variable rate is. Uh, I got no further commentary on that. We're watching that, but I think it's too early to say what that's going to mean as far as what things look like. Number two, if we look at the intention of rates moving up, that we know a few things. Obviously, rates moving up for the idea around inflation, and so to curb inflation, that is why rates move up. So we know that housing prices have completely leveled off. They're not decreasing, but less sales are happening everywhere. That's been happening since March. We know the cost of oil has decreased. You'll see that at the gas pumps as the cost of gas has gone down, cost of oil. We know that even some other things as far as inflation goes, such as food prices, really only seeing the rises on the dairy side of things. That's a report we've seen lately. So a lot of meaningful movement that inflation has especially cooled. Don't look for prices to come down. That's a really, really big mistake people look at as far as housing. Don't look for prices to come down. Activity to slow, right? Activity to slow. Right now, still probably a prediction of another rate increase, although that chatters went down. Remembering that last week the Fed raised their rates 75 basis points. And so, that matters, as there is some correlation between that, as far as what can happen or not happen from that perspective, right? So that is something to be aware of from that perspective. A new strategy that I come with this week, presented to a few clients. How could you lower your payments as interest rates raise? You could convert your mortgage to an interest-only line of credit. You can convert 65% of the value of it. You can't convert the whole thing. That obviously just completely tanks your payments as far as on a monthly basis, because you're paying off no principal, it's just interest. And 2/3 of your payment lots of times is principal. So your payment could go down to a third even with rising interest rates. So that would be something you could look at. I've done with a couple clients. I'm on the fence if I like it, but that could be an option for many folks right now. If that is something to want to look at, that's a new strategy to look at. Converting your entire mortgage to interest-only payment. And I know you're going to say, Joel, are you recommending this? Well, no. My recommendation is to hold the line and to wait, but not lock in for sure, and just to inevitably wait until rates may drop down into the second quarter of next year. I've been surprised to find that when we run the numbers, even though we had a couple excited people earlier in July this month, hey, we would have been better if we locked in, or did I miss the boat? To find that, like, really it wasn't all that close, that at this point, their variable had very much so outperformed the fixed rate. And so the only people I'm finding that the numbers are closer to is people that might have bought, summer of last year, so they're 1 year into their term. The trick with that, of course, is that because they have 4 years left, what you are looking at is you're looking at the idea that you're saying, well, I would have been better on a fixed rate, but that's impossible to guarantee. You can say, well, by the end of the year, I will have paid more having a variable over having a fixed rate. But that doesn't anticipate the fact that you are also saying that you don't believe rates would change in the next 4 years, which is highly unlikely. So if I'm in a position where I took a variable, a year ago, you'll say, well, the number's going to change really quickly, or I'm better on a fixed rate. But you're forgetting that, that rates when they come down, you'll also benefit from that where you wouldn't on a fixed rate. And then, of course, if you're in the later stages of your term and you've had a variable for a long time, you've had the benefit, and once you get to renewal, you're already closer to renewal. Again, we're recommending if you need to look at two things. A, I'm rolling and improving my cash flow by cleaning up my debt, taking care of any renos or getting any cash out. Two, huge opportunity as far as what you could be taking advantage of, other properties, other opportunities. Market's way slower, and a lot more deals to be had if you want to buy a second property. Ran the numbers for a client last week, thought it'd be cheaper to do a refinance even with the higher rates, found that it was better for her to keep her existing mortgage, take out a second mortgage at 12% for her $100,000 that she wanted. So that actually saved her $27,000 over 5 years. So I say that because lots of times what we think is cheaper is not really cheaper once we do the math. People don't do the math because math is hard. And so when we do the math, we find out that things are not what we thought they were. The same has been the case when people said, oh my goodness, we ran the numbers for a client last week, really upset that they felt they could have done better taking a fixed rate, and they took out a variable last year in November. Their rate was prime minus 1.2 at the time, so 120. So that puts them right now at a situation where they're at 3.5, but they were at 1.25 at one point to find out that actually it was not close, and it'll take them at least a year of rate changes before they're going to be close to benefiting from benefiting from taking the fixed rate. And then, of course, we've talked ad nauseum as far as what the real risk of a fixed rate being the penalty that could be taken into play. Anyway, that's it for the variable rate update this week. A couple thoughts on the market, a couple new strategies, and a couple recommendations. If you need any help, please do reach out. Please do feel free to schedule an appointment and see if we can't relook at your situation. We are here to help. And please subscribe to our channel and share your video with as many friends as you can. We'd love to help you out. Talk to you soon. Bye.